Good evening and welcome to tonight's market wrap. We saw a textbook liquidity-driven rally on Wall Street tonight, with all three major indices closing sharply higher. The Nasdaq surged 2.54% to close at 25,809.66. The S&P 500 gained 1.75%, finishing at 7,394.30. The Dow Jones Industrial Average rose 1.86%, ending at 50,848.75. But the real story tonight is in the fear gauge. The VIX Volatility Index plunged 12.51%, its biggest single-day drop this year, closing at 19.44. This plunge has been confirmed by Reuters, and the driving forces are clear. Markets are increasingly pricing in a Fed pause on rate hikes, and initial jobless claims came in higher than expected. Money is flowing out of safe haven assets and back into risk. Let's walk through the capital flows. The 10-year Treasury yield fell 1.74% to 4.46%. Lower real rates directly lifted the valuations of tech and growth stocks. Tech was the strongest sector today. The QQQ Nasdaq ETF surged 3.97%. Nvidia gained 2.85%. MicroStrategy jumped more than 5%. Gold also rallied sharply, with spot prices up 3.38% to $4,253 an ounce. But crude oil was the big loser. WTI crashed 5.36%, and Brent fell 5.52%. This tells us something important. The market is not pricing a supply shock. It is pricing a global recession. The final destinations for capital tonight are crystal clear. Money went into tech stocks, gold, and cryptocurrencies. Bitcoin rose 3.43%. Money flowed out of crude oil and cash. The turning point for today's session came at 3 p.m. Beijing time, when the European Central Bank unexpectedly cut its benchmark rate by 25 basis points. European stocks surged immediately. Bond yields fell. Risk assets across the board strengthened. The euro dipped briefly then rebounded. The dollar index fell to 99.68. The offshore yuan strengthened to 6.7632 against the dollar. When U.S. markets opened, they picked up where Europe left off. Semiconductors and AI led the charge. Sentiment was euphoric. Now, I have to be honest with you. Our morning forecast yesterday called for a down day. We were completely wrong. The core mistake was underestimating how much the ECB rate cut would boost risk appetite. We also overestimated how persistent the VIX fear spike would be. There was even a negative headline during the session. The White House expanded restrictions on U.S. tech investment in China. But tech stocks completely ignored it. That confirms that liquidity expectations are currently overwhelming geopolitical risks. We are now seeing a very important structural signal. Tech stocks are up. Oil is down. This confirms that the market is pricing a recession-driven easing cycle, not an inflation-driven tightening cycle. We have a perfect triple resonance tonight. The dollar is weak. Bond yields are falling. Tech stocks are rallying. This points directly to a global liquidity easing trade. For Asian markets tomorrow, export-oriented tech markets like Japan and South Korea should open higher. Chinese A shares may also catch up and repair some of their recent pessimism. On the sector front, global tech and semiconductors are the strongest theme with an 85% probability. The catalyst is the double boost from the ECB rate cut and falling U.S. bond yields. Gold has a 75% probability of continuing to strengthen, supported by lower real rates and a weaker dollar. Crude oil is the weakest sector with an 80% probability. Recession fears are crushing demand expectations. On individual stocks, we recommend holding COHR. The valuation is reasonable with a PEG ratio of 0.92. The 5802 INP substrate stock is still above its 200-day moving average. Do not panic sell. But AKTS should be exited immediately. Short interest is extremely high at 87.6%, and the stock has already broken below its 200-day moving average. For tomorrow's trading strategy, we recommend a controlled long bias. Focus on US tech ETFs and gold. Avoid crude oil and related stocks. If futures hold their gains in early Asian trading and the 10-year yield stays below 4.5%, you can add to tech ETF positions. But if the VIX bounces back above 20, or the 10-year yield rises above 4.55%, stop adding immediately. The failure signal is the dollar index reclaiming 100, or gold breaking below $4,150. Our probability assessment for tomorrow is 55% up, 30% sideways, and only 15% down. The direction is clear, but keep your position sizing disciplined.